Hello, everyone, and welcome to today's PropMoto webinar. As always, I will be the host. My name is Franco. I'm the editor and co-founder of PropMoto. And today we're going to be talking about the economics and capital stacks of office to residential conversions. This is a very important topic for almost every country, but I think, particularly those that have empty offices and people that can't afford to live in downtowns. It's particularly important for us. We have built a whole kind of side to our website, a database for all of these conversions. So our readers can track what's going on, find out some of the conversions in their area, look at who's the, architects and engineers, and hopefully it's a valuable resource for all of you. I hope everybody can jump in there and check it out. It's also a very important topic for both of my panelists here. So they spend a lot of time thinking about these. We have very expert opinions about all of this with lots of experience. Just a reminder to everyone that this is live and I don't save time at the end. If you have an important question, go ahead and throw it out to us. We're happy to try to field it, especially if it's, right in our wheelhouse. So without further ado, I will intro the two people that are going to help me explain some of this topic. So we have Stephen Painter. He's Global Practice Leader of Building Transformation and Adaptive Reuse at Gensler. Hi, Stephen.
Hey, good to see you.
Yeah, good to see you again. Thanks for coming on. We also have Aaron Kraus. He's Managing Director of Market and Development and Strategy at Nuveen Green Capital. Hi, Aaron.
How's it going? Good to see you all.
Yeah, between the two of you, I think we have probably, I'd say I wouldn't say the majority of conversions, but a good chunk, right? And yeah, I'm really happy to pick your brains on how these deals get done. Really, I think that what we're trying to convey here is, how to understand the potential, the feasibility, and push these deals through, right? Both with design and financing. First, I always like to start these out with a bit of a state of the market, right? I know these things are changing. I know from experience, you can write an article about something and then a new administration comes in and everything gets changed very quickly, right? So I just kind of want to understand, based on what you guys are seeing right now from your clients, how the landscape is changing, right? And where we're at this point in time, to see, like, where these make sense. I think the first thing that is, an influence on these conversions is the state of the office market, right? I think what makes these conversions so attractive is that we have lots and lots of empty office buildings or underperforming office buildings, right? And so we have owners all over the country that are thinking, yeah, maybe there's a higher and better use of this building, right? That I can make more money of. We've heard quite a bit about the office market rebounding, right? I mean, I think we're starting to see, especially in certain metros, people are coming back to the office, right? We're kind of out of that, what's going to happen after the pandemic. So I'm just going to, throw this out to you. Do you think a office market rebound is, maybe making some of these conversions less attractive? Stephen, I'll start with you on this one.
Yeah, I mean, what you said at the beginning about it changes every day, or it really is that's happening live right now. Everyone a month ago was talking about how the office market rebound was going to save the offices, and every type of office was going to be popular. And then I think 2 weeks ago, Wall Street Journal published an article saying that the state of the New York office market was the worst it's been since the end of 2021. And that was all down to AI. They were saying AI is going to kill white collar jobs, offices are going to be obsolete. So somewhere between those two things is probably probably where the truth is,
Yeah.
depending on where you are and what market. One thing that's definitely showing through in the numbers right now, though, is that yes, some companies are coming back. Generally, higher quality companies looking for higher quality space, and that is driving low vacancy in a lot of the Class A and trophy class type buildings. Seeing that particularly in Toronto, where we are, where the banks are all coming back, they all want the top spaces. However, in contrast to that, some companies are just staying fully remote, and the companies who are generally in lower class office buildings aren't coming back at all. And that's meant this complete bifurcation of the market between desirable buildings in desirable locations and less desirable or undesirable buildings that people just aren't filling back up. That we've always said, the Class B and C office buildings are the ones that are great for conversion, and that's really continuing to play out, especially in the Class B stuff. And that is basically because it's not good enough to be interesting, and it's not cheap enough to entice anyone. So if
Hmm.
you're in that middle zone right now where no one's going to be excited to come into your building, but also it's not cheap enough that some, tenant is going to take it, but those buildings are struggling in almost every city, and they're also generally, a pretty good pick for doing a conversion.
Yeah. Yeah. And I think it's interesting too, some of the kind of non-traditional, buildings that are in the suburbs and, maybe don't have any amenities, the smaller ones that I think they're particularly struggling too, right? That kind of class B stock.
Yeah,
Aaron,
and they're struggling with conversions as well, right? If you're in a non-desirable, non-commutable location, it's bad as office and it's bad for residential. So
yeah, is
there are some just absolute losers out there, and those ones we're seeing defaults happening on them. And you can come and buy them. We're seeing buildings still trading at $1 a square foot
mhm.
if they are kind of good for nothing, as it were. Um, and then even the demolition costs then are too high to make them very practical. So
Yeah.
we're definitely seeing that phase of like just complete um, undesirable, unusable buildings coming through, and that's typical. That's happened through every kind of generation of building in our, 300-year history. That keeps happening.
Yeah.
Um, but it's definitely happened to those kind of 60s, 70s, 80s buildings right now.
Aaron, how about you? What are you guys seeing as far as the office market goes, and what does that tell you about the direction of conversions?
Well, a couple things. I mean, I agree with Steven. I think a lot of the narrative is just vibes based on what the latest headlines are, and people are going with that. I would note, I don't, and this is my own personal opinion, not necessarily my firm. I don't think there is such a thing as the office market. It really depends on what type of office and where you are. So, um, there is no national commercial real estate market or continental for my neighbors up north. There's no continental market. It just varies based on where you are. And so it's very hard to speak in that type of macro sense. When you look at conversions, so much depends on, square foot of that office cost, but also on the residential side, right? If you're looking at Austin, Texas, rents are coming down dramatically because it's just such an oversupplied housing market relative to what it was a decade ago. There are other parts of the United States, and I'm sure Canada, where the demographics aren't supportive of a lot of new construction. Large numbers of people leaving, certain states and certain metro areas. And then there are other places where it's really attractive. So I think it's very hard to discuss this topic in very broad brush. Conversions are a tactical, kind of laser focused opportunity. It's not something that works in all buildings. I think the audience here knows that it's a minority of offices that the math makes sense for this to work, and it's only a subset of markets where this could scale to any meaningful amount. And as always, that is cost of office and cost of rents that you can charge for resi, and what that delta is.
Yeah.
I mean, I know the terminal lease rate is so important, Aaron. Is that something that you guys think about quite a bit when you're doing underwriting for these, right? If you see a market where the rents aren't giving back, does that give you pause?
For sure. I mean, our credit desk is going to look at comps and it's going to look at what can be reasonably assumed on the revenue side of these multifamily properties. And we've done billions of dollars, and we'll get into it, but a specialty form of financing called CPACE here in the United States. We're in process of bringing this to Canada as we speak, to start in Ontario. But we've done billions of dollars of these financings and have done many conversion projects, a bunch of office to resi, but also industrial to hospitality and office to data center, kind of you name it, a lot of these conversions. And so much of the credit is predicated on what can be reasonably assumed from the revenue side for when that conversion is complete. And you got to
Mhm.
pressure test that, and you got to, apply haircuts onto, you don't want super rosy scenarios. You want a pretty reasonable assumption to make sure there isn't any type of delinquency or any problem with the asset when it comes out the other side.
I think it's worth picking up, Aaron, on what you said about oversaturation as well. That's something that we have seen a massive issue with in the last 12 months, really. And it seems to stem off of the back of uh, what people see in trends and what they see in rents. And I always use this analogy. In um, 6 months ago or something, we were looking at growth in Nashville. And they're like, Nashville's grown 7%. Okay, that was equivalent to 6 floors of office, right? You 7% growth in New York is dozens of buildings, 7% growth in Nashville is 6 floors. So people were rushing in, throwing money at them, overbuilding in Austin and Nashville, overbuilding labs in Boston by millions of square feet because there was growth, but the
Yep.
growth was a percentage of a small thing. So it didn't pan out. That's allowing people to go in and find where that saturation has happened and buy a good asset for a lower price. There's also a risk of that happening in the residential market right now. So being
The denominator matters. Yeah. Yeah.
yeah.
And Steve, I know you guys have a kind of feasibility calculator and try to look at what makes sense very quickly before you have to put a team on it.
Yeah.
But how do you look at it? Like, not only are the rents kind of a moving target, right? It's like, okay, what are they going to be after, a couple of years once this is done? But then you also have, it's segmented, right? Like maybe Class A, really, really high end rents are giving back, but maybe there's, a market for a 3 bedroom or a market for a workforce housing. So
Yeah.
how do you kind of look at the different options that you could come out of this with?
So what we're really doing is comparing buildings to each other, right? The market has, we've been doing this 5 or 6 years since we built this algorithm. The market has gone up and down and all over the place. A good building is still a good building. And
Mm-hmm.
that's really what we're working out. The market may change, the type of units may change, but you want to pick up a building that you can convert with the minimum amount of effort, right? And that if you don't have to replace the facade, if you don't have to redo the elevators, if you don't need to change exiting, all those things are still good things regardless of what's happening in the market. The final decision comes down to the kind of math of how much you can buy it for and what rent you can get. But if you've got 2 buildings next to each other on the street, the one that you have to do less work on is still going to be the one that is better to convert. And that's really what we're looking at. It's that physical side of let's do the minimum amount of work to get the maximum amount of value out of it. Let's make sure that everything we change in the architecture or the mechanical systems or whatever is a value add decision. So not just recladding it because, oh, it'll be prettier. Like we're recladding it because it's going to add value. It's going to, uh, or it's going to meet some code requirement or whatever. And that is always going to be a positive to the end pro forma. We want to get the maximum amount of units, the maximum amount of rentable square footage, with the minimum amount of kind of major changes to the actual asset itself.
Mm-hmm. What about incentives? Obviously, like I kind of mentioned the Trump administration, right? A lot of federal changes have been happening on the federal level, but a lot of these incentives are coming from cities and states, right? So have you seen there still being a proliferation of these incentives, even with the political landscape where it is?
So, commercial real estate to a large extent is a creature of state and local law. Obviously, and we're talking about the US here, but obviously affordable housing and multifamily housing has issues related to HUD and Fannie and Freddie and so on and so forth. But to a large extent, this is a creature of state and local law. So regardless of who's in the White House, that will not necessarily have a massive impact on these conversions. What I can tell you is it's very hard to see most of these conversions happening without some of the public purse coming in some way. And that can manifest itself in many different things. It can be TIF districts, it can be tax abatements, it could be historic tax credits or new market tax credits. In the effect of CPACE, which isn't really public dollars, but it is a public-private partnership. CPACE is present in a lot of these conversions, and we can go into why that is. But a straight up vanilla capital stack of call it 65% loan to value, traditional debt, 35% equity, it's really probably not going to pencil in 90% plus of these conversion pitches because the math is just not there. You just can't make it pencil. So, what I would say is a bunch of cities looking to invigorate their urban downtown cores have programs. Those are very often tax abatement programs, which we see in a lot of these, which make the pro formas kind of work in a way that otherwise would not without that abatement. We're seeing a lot of those types of programs in a lot of traditional cities across the United States. Steve, maybe you can speak more about Canada, but at least in the US, we're seeing that really, for the most part, be a necessary requirement for making these go.
Yeah, and I think it's worth saying that math issue applies to most residential right now.
Yeah.
If you want to build residential in downtown, it's not conversions aren't penciling, it's like objects aren't penciling. Big, big picture. The incentives, we've been writing incentive programs for dozens of cities across the US and Canada for the last few years and making a lot of them work. It is, as Aaron was saying, it's mostly city and state level stuff that is changing. I'll kind of get onto that in a second. But we always go to cities and we tell them when we start this process of working with them to put programs together that it's not just about the money. It's a kind of three-legged stool approach. You need the money, and it needs to be enough money to actually make things happen. And if you've got a limited pot of money, you need to do a limited number of projects. Because giving someone $2 to buy something when the thing costs $5 is just a waste of time. So, do less buildings, spend the right amount of money. The other part of it is the regulatory side, and in the cities that have done this very well, and Calgary is one of them, was one of the first to do it. New York has done it now, the City of Yes stuff. Just getting rid of the regulatory kind of red tape is a huge driver. So using the Calgary example, they put an incentive program in place, but they said if you don't make the building bigger, if you keep the same square footage, you don't need to go through zoning. So that took 2 years off the process. Don't need to rezone it to convert it. Great. They got rid of parking minimums because you can't go back to an office building and dig out underneath it and add parking, and it's just not possible. So they got rid of that. That made more buildings convertible. But that 2 years in saving and zonings and approvals and so on is millions of dollars. If you go buy a building, you're paying interest on it while you wait for the city to mess around. That is millions of dollars. So getting rid of that is a cash incentive in its own right as well.
Yeah, I've always wondered, Aaron, how lenders think about that, right? Because there is a certain question mark to the timing. I mean, obviously, some cities are better than others, but I mean, in California in particular, I mean, it takes a really long time, and it's like, oh, this is going to guaranteed be permitted in 6 months, right? So, how do you deal with that kind of unknown timeline of before you even put a shovel in the ground?
It's very hard to complete your capital stack without your entitlements getting complete. So a lot of times these developers will raise very quote unquote risky pre-development loans to do that expensive work. But to put together a construction budget and actually go out to a bank or a debt fund or some alternative lender and raise tens of millions of dollars, hundreds of millions of dollars that you'll need, you're not getting that unless you're largely through that process. And you're right, certainly in California, those entitlement processes can take years. So it's no joke. I would agree with Stephen. I mean, I think the bureaucratic red tape and Rube Goldberg device that I think a lot of these things require is probably the biggest headwind that I think this part of the market experiences.
Yeah.
Yeah,
And we're seeing because the last part of that kind of three-legged stool is positivity and certainty from the city. And we're seeing in Calgary right now that we can go from a client saying, "Hey, I'm thinking about building this building," to starting construction in 9 months. That's all the design work, all the permitting, budgeting, everything, start to finish in 9 months. If you took that to another city, LA, for example, that might be 3 or 4 years. That is just a massive cost driver.
absolutely.
Right. Yeah.
lastly, I'd love to talk a little bit about lending in particular. There's so many headlines around, regional banks kind of looking to get, building commercial real estate off of their books. Obviously, interest rates have come down a little bit, but probably not as much as most people would have liked to have seen. Aaron, how do you think what's the appetite for these kind of projects in the lending world, and who's doing most of this lending?
Well, you have a barbell problem. If the credit of the development is good and sufficient, you're getting term sheets thrown at you by everyone and their cousin. The problem is a lot of these debt packages, like they don't make sense or they're predicated on assumptions that are very rose-colored glasses. And if your project doesn't make financial sense, you can hire a debt broker and go to 100 different lenders, and you're just not going to get a term sheet. So it's kind of for those that have a great deal, you're going to get capital. For those that don't, it's going to be tough sledding. What I'd say is rates. So for since COVID, we were living in an inverted yield curve. So the short duration debt was more expensive than long dated debt. That has reverted. So here in the US, the 10-year benchmark is now 50, 60 basis points more expensive than overnight money, SOFR. And so construction debt has gotten kind of cheaper. But on the other hand, construction costs have gone up. I think the inflationary impulse we're seeing in the last couple of weeks is only going to add fuel to that fire. And so you're trading maybe slightly cheaper capital, but more expensive construction costs. Um, I think the headline here, though, is if you have a conversion project that makes sense, you're going to be able to get capital. And then it really depends on what you're looking at. How much leverage of senior loan are you looking to put on your property? If you're going out and looking for 50% LTV, you're going to get term sheets. You're looking to get 90% LTV, you're not going to get any. Are you using mezzanine debt? Are you using EB5? Are you using CPACE? What kind of does your capital stack look like? And that is really going to determine the financial feasibility of your development and also the actual returns that the GP will experience through that deal. And then how you structure that capital as well. We can go into kind of how we've structured conversions in the past, but that's really essential to figuring out how to get this done.
Yeah, oh, yeah. The financial engineering is sometimes almost as complicated as the
For
the
sure, for
physical
sure.
engineering.
It's worth,
Last, go ahead, Stephen.
I was going to say it's because you mentioned where the federal treasury rate is right now. Under the Biden administration, we worked on a program to get them to lend money at below treasury for housing, which was going through Department of Transportation. And we were doing that because they already do that for TIFIA and RIF loans. It was complicated and weird, and it required all kinds of due diligence. I think it issued money for one project, and I worked on that for a long time. There's a bill going through the Senate right now to take that exact thing that we wrote and move it to HUD and issue financing at Treasury minus 2% through HUD, not for the full loan to value, but for a decent chunk, in the same way that TIFIA and RIF work for transit orientated development. So that will hopefully, although we've struggled with the last one, this should actually make a decent difference and help try and move more projects forward. So that's come out of Salt Lake City. Fingers crossed that will come through.
Yeah, I think the complexity of financing is really key. Not to plug what we do, but we did one of the largest conversions outside New York City this past December. It's called the Geneva in Washington, D.C., the District of Columbia. It's about a $750 million construction cost. Our share was about $460 million, give or take. It converted a full city block of vacant office in DuPont Circle Northwest, for those of you that know the District of Columbia, into over 500 apartment units. We got from a signed term sheet to a close in 30 days. That type of speed and that's we're amazing, I will admit, but it's not just about Nuveen Green Capital or even CPACE. I think what's important is the ability to execute fairly rapidly with as little complication and lack of I think execution risk and complexity bury a lot of these deals. And so I think that's also really key to getting some of these deals over the finish line. If you're in a financing agreement and that financing structure, it's going to take years to get there. It's not saying you could never get there, but that makes it really, really difficult. And there's a cost to that complexity. So even if you're getting cheap capital, if you don't know you're going to come out the other side with a check hitting your bank account to pay your GMP, that there's a cost to that. And I think simplicity and ability to execute is just as important as price.
Yeah. And just to plug Calgary one more time, because we've been working with them for a long time now. The way their incentive program works is that they give you apply, they give you a letter of credit up front, which allows you to go get a bit less risk on your money. Then the second you get occupancy, they give you the money. And everyone loves that. It's like, up to $15 million per project, about $75 a square foot.
Yeah.
You get occupancy, you can pay off, your construction debt or whatever. So that level of certainty and the substantial amount of money for the projects, and bear in mind that most projects in Calgary are much smaller than 500 units, is making a really significant difference to the speed at which those projects are going through. So Calgary now has 15% of all of their downtown office buildings getting converted.
Yeah, it certainly seems like, the speed and the risk, I think, are maybe factors that people don't consider, right? Yeah, you can see the building, you know what needs to be done, but when you look at the entire project, and there's so many factors influencing that, right? With the construction shortages and, all of that. But I mean, in general, do you guys see a different, now that we are a couple years into this, there have been lots of notable projects, a lot of successful conversions. Do you think that the conversation's changed a little bit with your clients? I mean, there is proof of concept for almost every type of building, right? Are you having to do less convincing, and maybe more, just advising? Stephen, I'll start with you on this one.
Yeah, I mean, I gave the same presentation about how office conversions are possible at least 200 times between 2020 and 2022. Um, I haven't really done that in the last 6 months, and that is just down to the fact that all of the clients we now speak to already know that this is possible. I don't have to go out there and convince them anymore. They've seen projects, they've seen stuff in their cities get built, and they are more confident. It has now gone from specialist developers doing it, and there are a bunch, but it was a very kind of specialized field. It's now gone from just those to a lot more mainstream, a lot more typical residential developers starting to look at it, and more contractors being more confident in doing it as well. And it is literally down to the fact that we could now take people to tour a finished project, and all of a sudden they see it, and two things change. Firstly, they are less worried about the complexity of doing it when they see one, because they're like, oh yeah, I get it. It's just looks like a normal residential project. The other thing is they're way less nervous about the ability to rent the building afterwards. And this was a huge issue for a lot of them. They were like, well, it's still going to look like an office building. Who's going to want to live there? No one wants to live in the office. And then they go see the finished projects and they're like, oh, this looks like a really great residential project. They don't see it as an office anymore. Like, some of the buildings we don't even reskin, right? So it looks like an office building on the outside. You walk into a beautiful lobby that is twice as tall as a typical residential lobby because you had that existing office one. You go into units with really high ceilings and great layouts and floor to ceiling glass. And they're like, oh yeah, I get it. So many people didn't get it until they could see a picture or go walk through a finished project. Now they do, now they have the confidence to do it. So we've moved from this kind of phase of education and convincing to a phase of just execution and construction and design at really high, large scale. And
Mm-hmm.
that's happened it's been we're ahead of the curve, right? So it's been happening for the last 3 years, but in the last year in particular, people are just um, way more convinced that they can pull it off. And the developers that have been doing it for 4 or 5 years are now convinced they can do even bigger projects. So they might have done their first one at 200 units, then they did a 500 unit one. We did whole house in New York, just over 500 units. Now they're like, well, that was good. Why don't we do 1,500 units? And like at some point, everyone gets a little bit nervous again, but the scale of the projects has gone 4 or 5 times what they were 2 years ago because of that level of confidence that people now have.
What about you, Aaron? What are you seeing as far as clients going, and maybe even the underwriters, right? Is there less trepidation about, hey, is actually going to pencil?
I don't know. Every deal is unique to itself. This isn't single family homes where you templatize and underwrite and you just stamp them. There's unique features on each one of these projects. They're highly bespoke and nuanced. We're rarely advising people to do this. We're usually just a capital, so they're coming to us with their debt packages. And look, I'd say a lot of these conversions do not work. A lot of the credits are not there. But the ones that matter, that work, we're going to be very energetic about, very excited about to fund. We think conversions are a great use of stranded assets of these office buildings in these cities. I mean, what else are you going to do with them? No one knows, and it breathes life into communities. And to Stephen's point, beyond the cost, I mean, you bring in tax base, you bring in commerce, you bring in restaurants, and really just the amenities that follow are very, very important. So we like these deals; they're good for the community, but I think it's important not to get over our skis. This is a subset of offices that will ever convert economically to residential. This is not every office you see that's 70% vacant. That doesn't necessarily mean that that's going to convert well. So it really, really depends on the nuances of the particular deal.
Well, it's a great segue. I think, when it comes to getting these projects done, the first thing I would love to talk about is just identifying, right? Which ones are, Steve, I know you guys have built a pretty sophisticated algorithm to do this without, needing to hire a team of analysts and all of that.
Yeah.
Walk me through how that algorithm kind of makes the calculation. What does it look at first, and how does it kind of shake the buildings out that don't qualify?
Yeah, for sure. So the easiest way to think about it is that we take the office building that you have. We are using just the information that we can get very easily. So what you can get from uh, CoStar, what you can get from the broker for the office building, whatever. So you get that broker package, pull all of the data from it. So square footage, floor plan, floor to ceiling height, all that kind of information, amount of parking. We put that into a huge spreadsheet. Next to that, we also have a spreadsheet of the perfect residential building. So all of the data about this Goldilocks make-believe residential building, the perfect unit sizes, the perfect quarter window depth, all that kind of stuff. What our algorithm does is take those two data sets and runs a comparison. So it says in your office building is relatively similar to the perfect residential building in these factors. It's further away in these ones. And then it weights those according to how much they would impact the kind of final value of the project. So if you're a couple of parking bays short for what your market is after, fine. If you've got a 100-foot quarter window depth and you want 35, not fine. So all of those are kind of weighted and then they're graded on a bell curve to give you this kind of balanced view of, your building's good here, but not so good there. Can we work out a balance across that? So all of the physical attributes of the project, the location attributes, do people want to live there if you converted it? Kind of important. And then it looks at the kind of regulatory stuff as well, to see where you'd land on that. It's incredibly kind of quick and efficient for us to do that in that way. And that's important because, as Aaron said, most of these projects don't work. So you've got to have a huge funnel of buildings that you're going to look at to funnel it down to the ones that are worth doing a bit more of a test on, to then funnel it down to the ones that you are going to do. So we've reviewed nearly 2,000 buildings. We are building about 15 to 20 right now. So that is
Wow.
a huge, 1% funnel of all of the stuff that we've looked at to get it down to the ones that really do actually work.
How about you guys, Aaron? When you look at it, like what's the funnel look like? What are some of the things that maybe, make something not financeable?
Again, I mean, you have the current state, the construction phase, and then the end state. So current state is, are you going to acquire that building for a basis that makes sense? Is are you getting a GC where there's a guaranteed maximum price that makes sense and that GMP is pretty ironclad? And at the end case, are the revenues going to support both that acquisition of the property and then that construction phase? And that, again, we're going to use comps of other things in those submarkets to look, oh, all right, you're building this number of units, this amount of rent, multiply that out. Let's see what that looks like. Let's see what the, operating costs of that building are. And does it pencil? And so, again, a lot of these deals will not get there. Either the basis of the purchase is going to be too high, the construction is going to spiral, or the GMP that we're seeing has a lot of holes in it, and all of a sudden a $60 million construction cost, really, that's going to be $85 million, right? If you assume everything does not go perfect. And then on the other side, are you basing your rents that are 25% ahead of market? Maybe you can get those rents, maybe you don't. And what happens if you don't? And so a lot of this is pressure testing the credits and making sure it gets there. The other thing is when you look at this stuff is it more expensive to do this than to do ground up, straight up construction? Sometimes it's easier to just build new units, right? So again, it's not a cynical look. It's a very realistic look that we want to do these deals. They're a great use of assets. We fund CPACE, which is commercial property assessed clean energy. So we finance the energy and water related hard and soft costs. There's no better use in terms of energy efficiency and embodied carbon than converting structures that exist. So we really do love these projects, but we are keen on looking and making sure they make sense. And so we're not going to get ahead of our skis and finance something that's going to be a real problem child, a few years down the road. The other thing I might note is because our financing, CPACE in particular, we can oftentimes go out 30 years at a fixed rate. We can am out the debt service as a much larger kind of arc so that we hit the debt service much more shallow. And so a lot of these deals look to CPACE as a means to kind of improve kind of the economics. So we're seeing a good share of these deals that are being considered now, at least in the States.
Yeah, I want to stick on financing here for a second, so I'm going to lean on you here, Aaron. If you're an owner and you're looking to do this, right? Obviously, you're shopping around, you're looking for all the, regional people or national people that can maybe help you push this through. What's maybe a tip to help find the right lending partner, right? I think a lot of lenders, it's troubling sometimes when you get in and then it falls out, right? Halfway through. What are some of the things you think
Yeah.
people should look for?
Surety of execution's up there. I mean, I would hire a debt broker, me personally. So one of the big houses or one of the more kind of specialty houses, they'll typically charge a point, a full point, and they'll help arrange your cap stack, make sure your equity, your GP and your LP equity is well structured. They will typically look for an A and a B piece in that cap stack, so a senior loan and then either a mezzanine position or pref equity or something specialty like CPACE. For us, we're typically about 35% of the capital stack. Again, 30-year fixed, non-recourse type of debt, very, very cheap relative to other kind of competing sources of capital. But they'll help arrange that. Maybe debt fund execution is right for you. Maybe regional bank execution. Really depends what the ticket size are. If you're doing a $12 million conversion or you're doing an $800 million conversion, those are going to be different players on who can actually write those checks. But they will help put together a real bulletproof debt book. The things that we or any of our peers would want to see as a pro forma, sources and uses, kind of the entitlements, starting some of those third party reports, the environmentals, stuff like that. There's a lot of moving parts that go and a very complex kind of choreography that goes into closing a cap stack like this. And so if you're a big outfit with your own capital markets desk, a big developer, maybe you can do it on your own. But if you're, four guys trying to, convert a small property in Cleveland, you might want to bring in a third party help to arrange that.
And maybe tell me a little bit about CPACE and maybe some of the other options, right? Are all of these conversions applicable for CPACE, or does it have to have certain elements
For
to
the
qualify?
the vast majority. So CPACE is a creature of state law in the United States. So we have it in 38 or 39 states, almost all the major markets. And the state law lets private capital. So Nuveen, we're like a $1.4 trillion asset manager. And our division, Nuveen Green Capital, we do CPACE. But the law lets us finance energy and water related capex in commercial or multifamily real estate. And in some places like Florida, we can do a hurricane resiliency, in California, seismic resiliency. But for the most part, energy and water related stuff. So that could be cool things like solar panels, but it can be very boring but essential things like elevators and windows and HVACs, so on and so forth, both the hard and soft costs. So when you're doing a conversion, by definition, you are doing a lot of CapEx that impacts energy and water performance. So almost certainly you qualify for our dollars. And in fact, in most of these deals, you will run out of our money before you run out of measures that you can finance. So we finance those measures through a benefit assessment. So it looks like a sewer assessment almost. It's a tax
Hmm.
assessment. And that tax assessment is levied by the local government. It's funded by private capital. It's not guaranteed by government. So if someone defaults, we're not made whole. But because it's billed and collected via the property tax system, it gets a massive credit enhancement. And so we're able to lend very, very low cost fixed capital over 30 years, which is very financially accretive to the economics of these particular
Mhm.
types of deals. And so we're finding a lot of these deals coming to us seeking term sheets, seeking quotes. And we're typically, don't quote me here, and it really depends on what the deal is, but call it, we're putting out 10-year treasury plus call it, 300 fixed for 30 years. So right now that's, call it around 7% money. That's going to be very cheap in construction terms for these types of deals. And again, that price will vary. It could be plus or minus, a lot depending on what the credit is. But just to give you a ballpark of what this looks like. And so that's CPACE, and almost all our deals involve senior lenders who are taking the bulk of that debt stack. It involves tax credits and, as I noted, abatements and all other types of programs. A lot of times you have to put together a puzzle to basically come out the other side with a financially feasible deal.
Yeah, absolutely. And is there prepayment penalties on this? Like, what if someone's saying, "Hey, I want to wait till the interest go down a little more"?
Yeah. So, typically for a lot of these deals, first of all, we're capitalizing the debt service for the first couple of years, certainly through construction, because you don't have revenue. So we can either capitalize that debt service or do interest only payments, oftentimes. We have there's no lockout or yield maintenance. There's typically a prepayment curve, but
Hmm.
that can be negotiated around, right? So a lot of multifamily developers who will refi into agency debt in year three, they'll turn our prepayment penalty down to some de minimis amount, maybe 1%, say in year three at stabilization. And maybe you pay a slightly higher coupon for that. But it's Microsoft Excel, right? We're solving for a minimum yield. So you can turn up and down that prepay based on what your business needs are. But if you want to basically use this as bridge and take us out in year three, you can basically structure your assessment to basically look like that.
Hmm. Yeah, the only silver lining to the interest rates not going down as fast as people thought is that I think there's a lot less people sitting on their hands, right? I've talked to a lot of owners for the last few years. Oh, we're gonna wait, we're gonna wait. It's like, well, you said you're gonna wait.
Yep.
Like it might be a long,
You know,
long
I
time. Like
I
maybe
go to a
just
lot of
start.
I'm on a lot of panels, and no one knows where. If I knew if rates were going up or down, I'd own a Caribbean island and be sitting on it.
Yeah,
No
you'd
one
be.
knows. No one
Yeah,
knows. And by the way, the forward curves is the market telling you where it thinks it's going. So no one knows where interest rates are going. Literally nobody.
right. Okay, I want to talk a little bit about the design on this, right? And how to, what to think about as far as getting this done smart. I think, the conversations I've had with you, Stephen, have been interesting about, there are some things that it really does make sense to save or try to find a building where, a facade, right, is a great example. But other things that, you kind of know you're going to rip out and replace anyways. So maybe it isn't quite as important. Maybe give me a rundown on some of those, like a checklist that people can kind of think about quickly here.
Yeah, I mean, as I said, you want to keep everything. That should be your
In
first.
an ideal world.
Yeah. So what that means from a design point of view is that every time you see yourself demolishing something, you should question why you're doing it, right? Um, there's always this kind of desire, I think, from a design point of view, to just strip everything down, start afresh, do it new, and make it nice. You won't ever get a conversion to pencil if that's your attitude. So everything we do in these, we question why, right? To work that out, we fully model out the entire existing conditions based on the as-built drawings from, whenever it was built. And then you go through and you say, why am I, I want to do this. Why am I doing it? Um, so the major ones that we, of course, look at that you're going to assume are going to go, to be honest, all of the interior fit out, like all of the tenant work that's been done for office tenants, that's probably all going to go. However, we keep as much as we can, keep the lobbies, keep the lobby finishes, keep the elevator finishes, keep the elevator cladding on the, on the core, on the upper floors, keep as much of the facade as you can, keep all of the structure, try not to add any holes, take out any structure or anything like that. Um, and then we're mostly keeping the major mechanical systems on the roof, and then changing almost everything that's branch distribution out on each floor. Um, that's where you want to be. It doesn't always work out like that. And when you're buying the building, you want to be looking at, am I buying a building that's 50 years old that's never had any maintenance done? In which case, I want to be paying almost nothing for it and assuming that all of that equipment's going in the trash.
Mhm.
Or am I buying a building where it's got a new chiller, it's got a new boilers, whatever, and I might be able to save it. But most of the distribution is going to get switched out. Um, then we go through literally everything else. Like some of the projects we're doing right now, it's a punched window facade in brick cladding. We're switching out about 10% of the windows because we needed to add vents in. So we are selectively going through, well, this IGU's got leakage problems, we'll take that one out, we'll put in a window with a vent. We needed to add operable windows to the bedroom, so we're taking that out, adding the vent and the operable, and doing that kind of very, very fine grain level of analysis on exactly what you need to do. Um, some projects we're overcladding, keeping the existing facade, adding insulation on. Some projects we're completely recladding, but each one of those decisions needs to be made like on a really detailed level. And I can't kind of emphasize that enough because you will very quickly put your construction cost up 30% by just like
Mhm.
hitting delete on something in your drawing.
Yeah, I
Um,
think it's fascinating too. Obviously, the windows, the operable windows, and the facades, that's a huge piece of this. But you're
yeah.
saying, just because you don't have operable windows and you need them, depending on the type of construction of your window, there's actually workarounds, right? You can cut them down
Yeah,
and
and if you got curtain wall or window wall, you can go take the IGU out and replace it with a glazed inoperable. We're doing that very, very often.
Mhm.
You just don't need to replace the whole facade to get 10% of the windows to be operable. It's just a kind of ridiculous thing to do. So overcladding, window replacement, we're doing that a lot. Um, we're doing some kind of additional facade insulation on some of the projects if they require it because of, New York, for example, local law 97 means you got to really kind of add insulation to most of these projects. Um, but yeah, it's really got to be minimal. It's got to add value. So
Mhm.
if your potential future tenant doesn't walk in and think, this is great, I'm so glad this is different to what it was before, then you shouldn't really be doing it.
Yeah. And finally, just talk to me about this kind of building, residential building that feels like it's intentional, right? I think some of the trepidation was, hey, I have this building. It's just going to look like a wonky office building that someone threw some walls up and tried to make it work, right? And so, what are some
Yeah.
of the design choices that can be made to really make these, like you say, a great place to live?
Yeah, I mean, honestly, once you put all the walls up on the inside and you put beds and washrooms and stuff in, it kind of just looks like a residential building. But there are a few things that are kind of worth thinking about. The lobbies is a key one. Like, what's that experience when you walk through the door? There is a very different feel from an office lobby to a residential lobby. Um, The facade is one that people worry about. I think more architects worry about it more than tenants do. It's a kind of an odd thing, but we've done some conversions that still look like brutalist office buildings on the outside, and inside they're beautiful. So no one really cares too
You don't
much.
really see the facade when you're in the building. Yeah.
Yeah, exactly. And architects have this thing of doing like renders from 20 blocks away from a helicopter that's floating in midair, and you're like, oh my God, the building doesn't look nice. But it's like everyone else in the world views it from the sidewalk, like looking up and
Yeah.
think. So yeah, if you can get the ground floor experience to look right, if you make it feel like you're walking into a really nice residential space, that's a good start. Once you get off the elevators, that's got to feel like a residential or kind of hospitality style corridor. Once you're in the units, it feels like any other unit. You can then start to make decisions based on what that existing building has given you. And we've done a bunch where we've stripped out the ceilings and done exposed concrete, done a kind of loft style
Hmm.
apartments. It doesn't look like a ground up new apartment, but it has something more interesting to it. We've done others where we've dropped drywall ceilings in and stuff. You really have to just look at what that existing building has given you and saying, is this is this cool? Like, is someone going to pay extra for this? And it's a weird balance, right? If you 10 years ago we were doing a lot of like loft conversions, converting old factories and warehouses to residential, and you'd have that kind of industrial chic look, and you'd do exposed timber beams and that kind of thing. Think about these office conversions in the same way. Like, does the exposed concrete structure look cool? Are people going to walk in and be like, oh, this is a differentiator? I could have rented that new building across the street, but in this one, I get better ceilings and I get this kind of cool feature. So you have to think about the overall kind of aesthetic that you're going for. Think about on the lobbies what you're going for as well, and what you can maintain there. Like we're doing one in Calgary right now where it's an affordable housing project and it's going to have the original terrazzo floor and marble walls because like why the hell would you tear that out? It's very beautiful and very expensive, but we're going to have to balance that with some much more residential features because it really still looks like an office lobby until you start adding some of the wood in, the kind of concierge desk, the
Hmm.
all that kind of stuff. So you got to get that balance of like enough of the office left over to be interesting and enough new to make it feel like a home.
Absolutely. Let's talk a little bit about incentives. I know we've talked to how they're maybe one of the only ways to get these to push through in certain places. I mean, how can owners know that they are getting all the incentives that they can out of it? I know, like, examples like a historical preservation incentive, some cities are pushing those. How can maybe they be sure that this is that's their capital stack is good because of the incentives?
Again, I mean, historic tax credits in the U.S. are billions of dollars a year. Same with new market tax credit. I would hire a professional to
Mhm.
help work this financing, unless you're a big firm where you have specialists that do this. Again, if you're not that, again, there are a lot of names out there that could help, put this cap stack together, and it's well worth the point that'll be capitalized into the financing amount. That's the typical kind of cost. It might be plus or minus depending on who you go with, but that will pay itself off many times over if you optimize your cap stack. So I would do that without knowing. If you're doing something in Kansas City or Seattle, there's no way to know all the myriad little nuanced little programs, little ways to snake out some additional return. These people are paid to know that.
And are there any incentives that are maybe, I don't want to say red flags, but it maybe kind of seem less concrete than others? I know, like Chicago, for example, it'd be kind of, we had like a couple mayors come and go, and each one was into the incentives program. The other one wanted to slash it. Is there any worry, Aaron, as when you guys look at these, like, well, is this incentive going to be there when this goes through, or do you just take these as fact?
So, I mean, we won't close our financing unless the cap stack is complete. So,
Mhm.
but look, if you're going to go, we're not public money. We are a private lender. It is all private capital. But if you're going for some public purse dollars, there is an inherent risk with it disappearing before you can close your stack. And if it disappears and it blows a $6 million hole in your cap stack, you've got to fill that with something. Maybe it's an equity call to your partners and you're raising more equity, or maybe your only chance is really, really expensive debt that's gonna, blow out your return. I mean, that's the inherent risk with developing. So if you are looking for public incentive dollars, I would, pressure test it, make sure you feel pretty confident that it'll be there when you need to close.
What about if there's an affordable element? I know, like, yeah, here in California, a lot of places you get a bonus, you get a density bonus for that. Does that make your underwriting harder? Do you guys not like to see that, or do you maybe like to see it because it kind of becomes a social element to it?
So, I mean, to get entitled in most major cities in the US to even do this, you're going to have an affordable component to
Yeah.
begin with. So, I think it's table stakes. Obviously, how much of your property is quote unquote affordable or deep affordability, that impacts the economics, it impacts everything. That's part of the puzzle piece. But it's hard to imagine doing a significant deal, and getting all the permits and entitlements from your local jurisdiction without some eye to affordability, at least for some percentage of those units.
So does that mean that you see some low income housing tax credit come into the capital stack as well?
It's certainly possible. Yeah. Light
And
tech has its own complexities, but yeah, I mean
but
that is a
that's
popular
not like a
alternative.
deal killer for you if there is a light tech component.
Not necessarily. No. At least for CPACE, we're pretty agnostic onto other things in the cap stack. But again, there's no one size fits all. Even if you're doing two deals in Chicago or Los Angeles, they're going to look completely different than each other, even for two deals in the same jurisdiction. There's just no way to paint any of this with a broad brush whatsoever.
Absolutely. And what about Stephen?
It's
Does it make it harder to design if there is an affordable aspect to it? I mean,
no, I mean most of the time you're not allowed to design the affordable units to be different, so it doesn't make
mhm.
any difference. I will just say like the cities that we're seeing that haven't put affordable requirements in are actually seeing more affordable housing getting built. And it seems totally counterintuitive. If you put enough incentives in there and you let the developers do the types of um, projects that the market is after, you see a lot of affordable going in. And that is often a factor of the most hard hit downtowns. The only market in the downtown is for affordable housing, and it's different, not New York and Chicago or whatever, but the smaller downtowns, um, there is there's nothing there. So it's not a desirable place to go build luxury housing. So developers are picking up the incentives, they're going in, they're building what the market wants, which is affordable housing. It's a great way to then drive a change in the downtown market. And we're starting to see cities that are like celebrating getting their first grocery store after doing some of these conversions because all of a sudden there's people living there that need to
Mhm.
buy groceries. And then that's something that's desirable for more market rate housing to come in because all of a sudden there's transit jobs and you can buy food. Oh, and the restaurant's now open past
Right.
7 p.m. and the stores are opening on the weekend for the first time. So that affordable housing piece can start to be a catalyst for other, market rate housing and other kind of positive community knock-on effects to happen. But
Absolutely.
it doesn't need to be uh, as restrictive, I don't think, as some cities have made it. Just going back to the kind of incentives piece and whether it has to be how risky it is and so on. The best recommendation I have on that, honestly, is go on the city website or the state website and find out if there's someone you can call at the city who's going to pick up the phone and talk to you about what their incentive programs are. If there isn't, then go pick a different city to work in because the ones that are doing this right are being very proactive in helping
Mhm.
out people who are going to create housing.
If they're not helping there, they're probably not going to help through the whole process, right?
Exactly. And if there isn't a very clear, simple way to understand what the process is and what the incentives are, then they are going to be a pain in the ass from the day you decide to do the project to the day you close occupy your building. If they're clear, if there's someone you can call, you're going to have an easier ride. And that's what's attracting some of the developers we work with to specific cities, New York, Calgary, Nashville, like all these places where you can pick up the phone. Atlanta is a great example. Pick up the phone and call someone and be like, "Hey, how do I negotiate this process? And like, what different types of incentives and tax abatements and TIF and all that kind of stuff? What can I stack to make this happen?" If they give you a clear answer, it's probably a good place to
That's
go
a
do
good
business.
sign. Well, that's a great place to start. We have to leave it there. I just want to thank Stephen and Aaron, both of you, for joining us. If anybody would like introduction to either of them, please send me an email. It's franco@propmoto.com. That's FRANCO at propmoto.com. Thank you, everyone, for joining. And Stephen and Aaron, hopefully speak soon.
Yeah, good to see
Great.
you.
Thanks, everybody.